In part 2, we take a second look at how the way you get paid affects your accounting system. However, this time, instead of focusing on the two home bakeries selling bread for cash, we'll look instead at the web developer providing services to other local businesses. In his case, we assume he issues invoices and collects payment after providing services. In other words, he must work on an accrual basis. The reality is that all businesses all businesses except certain farmers and fishermen, fisherfolk, report their income on an accrual basis. However, in spite of this, public accountants working with our smallest businesses almost always create cash basis books of account and then adjust to accrual. This is quite easily done, but only if the business maintains accurate records of invoices issued to and payments from its customers. After taking a second look at the Getting Paid slide, we discuss invoicing briefly. Finally, we examine the conventional wisdom about the importance and usefulness of financial statements for owner-managers. While accurate financial statements might be useful to help owner-managers manage their businesses, that would only be true if, 1, they were available on a timely basis, and 2, if the owner-manager was familiar with the accounting algorithm. In most cases, neither of these conditions is likely to be true. Finally, it's important to reiterate that we have not dealt with either payroll or sales tax obligations in this workshop. Our smallest businesses can often function pretty well using a cash basis system during the year, with one exception: getting paid. If you're like most Canadian small businesses, you probably sell services. Most often, customers don't expect to pay for services until you've finished providing them. They want to see what you've done before they pay you for it. Even the building trades, which theoretically produce goods, often have to build their goods to order, which is really a lot more like providing a service than selling a pre-existing thing. As a result, you typically have to keep track of materials and your labor. Once you've finished, you present your customer with an invoice or a bill. Then your customer owes you money. This is where much of the complexity comes from for our smallest businesses. It's also pretty important since that's what we operate small businesses for. That is, to get paid. And every business is a little bit different. Some businesses work almost exclusively with just a few or even just one customer. That is conceptually much simpler than working on multiple small jobs or projects at once, particularly if you have many different customers. In this workshop, we'll first look at some very simple situations. To do that, I'll have to give you a little background on our prototype business. I spend about half my time on a small rural island near the capital of British Columbia. A home baker on the island sells bread directly to residents. She has a small shed adjacent to her home where she keeps the bread and a locked honor box with a slot for customers to insert their cash payments. After a while, she got customers to write down their names and email addresses, and she gave them her email address. That way, after taking our bread, we could send her an electronic transfer. Her new and improved system meant the money was deposited automatically into the bank, thus saving her the hassle of depositing it herself. There are actually 2 home bakers on the island. The second gets his customers to pre-order the bread on his website for pickup on either Thursday or Sunday in the parking lot of the local shopping mall at specified times. He also uses electronic transfers. Obviously, his system is a little more secure since you have to pre-order the bread, and he makes sure that you only pick up loaves that have your name written on the bag. I would presume that his website has been programmed to produce a list of customers and their orders. Otherwise, he wouldn't know what to bake for them. Both of these bakers are selling products. In each case, there is an exchange of goods for cash. The accounting for sales in these businesses is about as simple as it gets. They are properly and easily accounted for on a cash basis. Once they have been paid, the money finds itself in their bank accounts. There is no need to record the transactions. They can simply harvest them by downloading the transactions from their bank. Next, let's look at a service business. We could, for example, look at the business of a website developer who creates e-commerce websites for the likes of our second baker. The baker and the web developer must agree on either a fixed price or an hourly contract. If they agreed on a fixed price contract, the two would have to agree on when payment was to be made. If payment was made after completion of the website or on an hourly basis, the baker would owe money to the web developer once the work was done. This would result in the preparation of an invoice describing what was done and how much was owed by the baker to the web developer. From the web developer's point of view, the amount owed to them is called an account receivable. From the baker's perspective, it would be called an accounts payable. Our first set of transactions didn't result in either accounts payable or accounts receivable. Bread was simply sold for cash. These types of transactions can easily be accounted for on a cash basis. However, the transaction between the web developer and the baker should be accounted for on an accrual basis, which is a little more complicated. The web developer must keep track of the work done, the invoices submitted, and the cash received. The baker should also keep track of what he owes, but can probably rely on the web developer for that, for obvious reasons. The more customers a business has, or the more complicated the materials and services provided, the more complicated the system required to track all this information. For a cash-basis business, there may be very little need for a sophisticated accounting or bookkeeping system. Similarly, if you only have one or perhaps two customers that you work for, you may be able to handle the complexity yourself, without resorting to setting up a formal accounting system. But if you need to issue invoices and keep track of payments from multiple clients, you should probably consider one of three commonly used accounting systems. These are 1. QuickBooks Online. 2. Wave Accounting. 3. Xero Accounting. In addition to tracking receivables well, they make it easier for your clients to pay by credit card. Making it easier for your customers to pay you is invariably a good idea. If you're attending this workshop, you probably don't have much experience using accounting software. These days, the assumption is that if you are, it should probably be an online version. Online accounting software should handle the needs of virtually any small business with fewer than 10 employees. In Canada, that means 90% or more of all businesses. These businesses typically outsource at least their financial statement preparation and tax filing work. Online software makes it simpler to share records with your public accountant and makes collaboration more efficient. Keeping track of what your customers owe you and making it easy for them to pay you are why most of our smallest businesses should seriously consider using the online version of your chosen accounting software. It probably makes sense, even if you only use it to create and send invoices to your clients. Ask a business instructor at college why the owner-manager of a small business needs up-to-date accounting software, and you'll probably get an answer something like this.
Owner-managers of small businesses need timely and accurate financial reporting so they can use the information to manage their businesses.
In reality, that's simply hogwash. Just a couple of months ago, I was preparing the corporate tax return for the daughter of a friend. She'd had a colleague with an MBA in finance do the accounting for her company in QuickBooks. Her colleague had graduated from a recognized MBA program a few years earlier and was working as a senior financial analyst at one of Canada's largest municipalities. She had been promoted to the senior analyst role about a year ago, after 2 years as an analyst. Unfortunately, the corporation's bank account and sales figures were overstated by $80,000. It's pretty hard to understand how a finance professional can overstate the bank balance by $80,000. It was a cash business. You only had to look at the bank statement. If a master's degree in business administration doesn't ensure a solid understanding of accounting, is it reasonable to expect that watching a few YouTube videos will prepare owner-managers to do a better job? Even public accountants who prepare financial statements for a living generally use something called working paper software to mock up the financials before posting the adjustments to the accounting software. Most often, owner-managers are very time-constrained. They invariably focus on the profitability of individual jobs or projects and watching cash flows. The intricacies of the matching principle, or adjusting from cash basis to accrual, are usually out of their reach.